invite the panelists. I'll introduce them as they come on stage. Margaret Liu is the Vice President and Deputy General Counsel of the Conference of State Bank Supervisors. Previously, she worked at Fannie Mae and some other pristine areas. I noticed that you had a JD from the University of Chicago. To her right is Rob Morgan. Rob is the Vice President and the Fintech Guru at the American Bankers Association, a graduate of Connecticut College. Rob has rapidly risen in Washington because he gets Fintech and the future of banking. To my left is Jean Hogarth. Jean is a Senior Vice President for Public Policy at the Center for Financial Strategic Innovation, CFSI. I first met Jean when she was Senior Executive at the Federal Reserve Board's Consumer Affairs Division. You've been a teacher at Cornell,
Yep.
have your doctorate from The Ohio State University.
OH.
And on our far left is Richard Neiman. Richard is the Senior Vice President for Regulatory Affairs and Policy at Lending Club, the nation's largest online platform lender. Richard has a distinguished history, having been the state banking supervisor for the great state of New York. Previously, Richard also worked at the OCC, TD Bank, PwC, and Richard and I really got to know each other at work at the Bipartisan Policy Center, where he co-chaired the regulatory reform initiatives, regulatory restructuring, which we discussed here earlier. So, I've proven to everybody in the audience that we have a distinguished panel of a diverse set of backgrounds. Let's get right to it. I asked Congressman McHenry for his 3 ideas as to kind of 3 things that would, government could do to promote innovation and growth. I asked him to all of you. They can be big or small. They can be federal or state. Anything you want, with one caveat: it can't be a double negative. You can't say the federal government shouldn't not do this. Right, we got to have action here. So, Richard, what's your top 3?
Right, so Aaron asked us to focus on what is realistic in terms of policy recommendations. So I think I came up with 3 practical recommendations that could be implemented, in my opinion, with many of which without legislation, and I do believe in a bipartisan fashion. The first one is the easiest to implement. And for the first time, I was actually preempted by Congressman McHenry, and to use a relevant term here, I was really preempted by his discussion around the 4506T. Because under this 4506T, taxpayers, as he explained very effectively, can request that their tax data be provided to lenders as part of the application process. But unfortunately, this process is very manual, it's paper-based, and as a result, what could have been done instantly can now take, as he referred, up to 8 days, which prevents the use of this tax data in credit models that price and approve loan applications just in a matter of seconds. Bringing this process into current technology by creation of an API would be a very simple improvement that could enable lenders to offer lower cost funding, faster, easier, safer, and expand access to capital for consumers and small businesses. It would also, most importantly, likely increase loan approvals for those with lower credit scores, but with stronger creditworthiness that would be evidenced by review of their taxes, a position that many small businesses find themselves in because of the individuals who tend to be supporting their businesses on personal credit cards. It'll also save the IRS money and would be a big benefit, obviously, to consumers. And in fact, we actually offer to even provide computer engineers to help build it, if that helps. The second recommendation involves the need for greater coordination and cooperation among the federal and state agencies with respect to supervision and examination of the banks that have entered into multiple banking arrangements with non-bank platforms. So this recommendation builds on the proposal from our Bipartisan Policy Center Reg Architecture report mentioned by Aaron in 2014. Much of our report, and I co-chaired that along with Mark Olson, a former Fed governor, focused on structural reform, consolidation of the agencies at the top, focusing on prudential, distinguished from business conduct. But it also included a often unnoticed but very important pilot program that would not require legislation, that would focus on the bottom, to evidence that examiners could effectively work together in a coordinated fashion, coordinated by the FFIC. I now see that development in Fintech as a perfect candidate to benefit from such a pilot. And under such a pilot, I can envision a joint exam team focusing on banks who are partnering with platforms, possibly through a bank that acts as an issuing bank, as well as banks that are purchasing or originating through the platform, whether national or state. And you can envision this pilot to be performed with one first day letter, one lead examiner with a team with broad experience, including technology, one exam report that can be used by each of the agencies. And in order to pursue greater coordination, cooperation, and consistency, I see no reason why you could not get wide support for such an approach. In my past role as superintendent, I would have called this a very good example of cooperative federalism. My third recommendation goes to the power of marketplace lending model and its diverse investor base to expand access to affordable credit in underserved areas, really picking up Congressman McHenry's focus on financial inclusion. The federal government currently provides tax credits that effectively draw investment into underserved communities. In particular, the Treasury's Department's New Markets Tax Credit Program attracts investments in commercial real estate in low-income census tracts. The Low-Income Housing Tax Credit Program attracts investments into low-income housing. The federal government has the opportunity to harness the potential of marketplace lending platforms to deliver investment into underserved communities or small businesses by creating incentives in the tax code that parallel these existing programs. I really do think it's possible that a relatively small amount of incentives could efficiently bring quite a large amount of investment into communities that the traditional banking models have underserved.
Great. Thank you, Richard. Jean?
So thank you. Those of you who don't know, the Center for Financial Services Innovation leads a network of financial service providers dedicated to improving the financial health of the United States citizens. And one of our signature products is our Financial Solutions Lab. And I would be remiss if I didn't remind you all that our competition for our third cohort opened yesterday. If you go to financialsolutionslab.com, you can find out the challenge that we're issuing this year, which is really to improve America's financial health, a modest little goal there. But as a result of the lab, we have an opportunity to really engage with a lot of financial technology providers who are at the accelerator stage, a little bit beyond two guys in a garage. And as we've looked at the lab companies and others that we interact with in this ecosystem, so my top three would be number one, passporting of state licenses. How's that, Margaret? And if you can't passport, then at least harmonize state requirements and create some reciprocity. We do this for driver's licenses. It is actually, in some cases, we also do it for gun permits. It's possible in the US, if you are permitted in 10 states, you actually are permitted in all 50 states. If you pick the right 10. So, if we do it for guns, we should be able to do it for financial technology companies as well. Speed up the approvals in the licensing process, and really get uncertainty out of the licensing, because uncertainty makes venture capitalists very, very nervous. And it's really hard for a lot of these fintech companies to get to scale if they can't get the funding. So number one is some sort of harmonization. Number two, and I know Aaron talked about us being realistic. This is aspirational, and that is to have our regulators go to a principles-based versus rules-based regime that really gets at compliance by measuring the success of the customers. At CFSI, we believe that it is possible to align the profitability of the provider with the success for the consumer. And we also believe that there can be fintech for good, that financial services can be a net positive for consumers. And so trying to figure out what the metrics are for those positive consumer outcomes and have those be the basis for the principles that then guide how we regulate in this field, because technology, as the congressman said, is advancing so quickly, and our regulatory structure and processes are just not able to keep pace. So we really have to think of some other way of structuring our supervision. Number 3, and we're working on this, both Richard and the congressman alluded to, your IRS data is your data. Consumers really do own their data. So can we have, number 3, some open data structures in place that allow consumers to access their financial data, that enable them to make the kinds of decisions that will help them improve their financial health? What are the principles for data access and sharing? What are the standards for APIs? I'm going to channel my inner Aaron and say, yes, real-time payments are part and parcel of this open data initiative. And how can we help consumers use that data to create some actionable decisions that get them not only included in the financial mainstream, but active participants in benefiting from those processes?
Great. Margaret?
Thank you. So CSBS is the Conference of State Bank Supervisors. We're the Washington policy organization for the state banking regulators in all of the 50 states. So first, in terms of the 1, 2, 3 that Aaron asked us to address, it's events like this. Let's talk about what the problem is that we're trying to solve. Is it a lack of innovation? Because the last time I looked, and there's a lot of different, it's hard to get good data on this, but there have been thousands of fintech startups in the United States over the past several years, in the US alone. Fintech investments, 2015 topping $30 billion. So I think it's important to have a discussion about what problem are we trying to solve. Secondly, it is important to remember, and you use the term government. You didn't say federal government.
Right,
so government is federal and state government, and there is a lot of government that exists outside of our bubble here in Washington, D.C. So let's look at RegTech solutions like the NMLS, the nationwide multi-state licensing system that the states use every day as a technology tool to license entities. And let's look at the innovation and activities-based regulation that is going on at the states today, and that has been going on for a long time. Third, let's make sure, and it's related to point 2, let's not stifle innovation by federalizing something and bringing something into DC where it will reward the best funded, largest players. It will cement those entities' roles, tilting the playing field away from the true innovators.
So I only had one rule, which is no double negatives.
Okay.
And I heard not stifle. Let's not stifle. So I mean,
There's only one negative.
No.
Okay.
So they have to be an action, not a failure to do something stupid. So I agree with you on the failure. I have a forthcoming piece with Brian Knight from Mercatus, where we actually argue one of our biggest concerns about this OCC charter, and we'll get there, is that nobody in the charter will fail like banks don't fail, right? We need more failure for banks, and we need a lot more failure for fintechs. Technology firms fail more often than banks, and they should, particularly startups. But not failing to not stifle something. What are something the states, you point out NMLS, state passporting is a good idea. What's something else that the states can do to move the ball forward rather than having the federal government not stepping in and stifling?
Well, one of the things that differentiates the state regulators from from a lot of the federal banking regulators is that state regulators regulate an ecosystem. They regulate within one regulatory agency, bank, non-bank entities, and a very diverse set of institutions within that regulatory portfolio. And one of the things that the states are doing is looking across that entire that entire financial services ecosystem to look at the opportunities for innovation across the entire portfolio. This is not about one business model or another. It is about local economies and bringing good, solid, responsible credit to local economies using a variety of tools and looking across the really diverse spectrum of financial services entities that are out there today.
Rob?
Great. Thanks, Aaron, and thanks for hosting this. It's a very timely discussion. Banks are obviously a really critical part of a lot of the innovation that's happening in the financial services industry. Banks are pro-innovation, and they're really excited about fintech. They're excited about the opportunity to partner with some of these new companies to help get these innovations in the hands of customers in some of the safest ways possible. So, with that, I think my first recommendation would be help facilitate bank fintech partnerships. It's very difficult for a lot of banks to partner with fintechs today. Usually, those partnerships fall into third-party vendor management guidelines, which weren't designed for working with new innovative companies. When you look at a lot of those guidelines, there's questions about looking back for 3 years of financials, for example. Banks shouldn't be limited to partnering with someone who's maybe 2 years old. They shouldn't have to wait for the third birthday. So helping to enable banks to better partner with a lot of the fintech companies is, I think, a really critical component of this. The second key piece is, and Congressman McHenry alluded to this, is the need to be able to pilot new products in a way that lets you actually test them with customers. And we've obviously seen this in a number of other countries. The term sandbox is often applied to this. I personally don't think sandbox is really the right term. When you think of a sandbox, you think of an enclosed area where nothing gets in and out, and you're building make-believe sandcastles. We sort of prefer the term greenhouse. You want a controlled environment to test a new product in a very limited scope with a view towards getting it out to the real world. And I think that can benefit banks. They can try new programs, try new technologies, and see how they work in a controlled environment. It can benefit the fintechs, and it can help facilitate those partnerships we were talking about. Banks can help pilot some of these partnership programs through sort of a greenhouse. Finally, I think it's really important that we look at some of the existing laws on the books that were written before a lot of these technologies existed. So a lot of these laws may inadvertently inhibit the use of a lot of new technologies, even though the intent was never to do so. One example of this is CRA laws, which are very geographic in nature. How do those apply in a world where we're lending more digitally and where your customer base may not be who's around your closest branch? So that's one key example. Another very common sense example is there are 5 states where it's illegal to take a photo of a driver's license. An obvious reason for this, you want to help prevent fraud, but it makes it very difficult to use new technologies to do things like online account opening. So I think those are really 3 tangible actions we could take today.
That's a good. I bet those 5 states. That's back when you could actually probably create a driver's license with glue and some good scissors, and we didn't have holograms on our driver's license. I appreciate your attempt to change the nomenclature. When I think of sandbox, I think of a place where my kids have a great time for 10 minutes and then they start fighting about whose toys are what. Let me turn to this level playing field concept that we brought up before, because I was kind of, it's a refrain I hear a lot from both banks and fintechs. We just want to compete on the same level playing field, and it's one that's very intellectually appealing to me. Rob, I thought you wrote it really well in the ABA's comment letter when you wrote, quote, "To customers, a loan is a loan and a payment is a payment," end quote. I mean, I think that's right. I brought this up in the context earlier about this CFPB prepaid card rule, where that's exactly what the Bureau did. They leveled the playing field for fintechs transmitting money and for banks. Same rules that applied to banks and debit cards that work really well should apply to fintech. I was very disheartened to see that some in Congress, senators introduced some legislation to roll back the prepaid card rule, which would effectively roll this back. Do you think that would be a mistake in this specific instance to unlevel the playing field by rolling back this regulation?
Yeah, so ABA doesn't have a position on that relative to the prepaid rule, but obviously the rule is broader than that and impacts a lot of our members in very different ways. But our focus has been on making that work for our members. But I think your question really gets at a broader point, which is a really important one, and the need to have consistent customer experiences, whether you're at a bank or not. So, like you said, to customers, a loan is a loan, and they don't differentiate where they get that. Those customers should have the same experience and the same protections, whether they go to a bank or to a non-bank. So I think that's really important, and I think in terms of the development of fintech, it's really important as well, because at the end of the day, banking and financial services is a trust business, and you need to have that level of trust with any entity that you're going to interact with. So I think it's really important that we have the pieces in place to make sure, and we've used the phrase activities-based a lot today, really focusing on the underlying activity that's taking place. If I'm lending, treat me like a lender.
Which is why I think the Bureau is so wise. When you're sending money, you're sending it. Whether you're sending it on a PayPal app or through your bank account, you're sending money and you should be treated the same way. What do you guys think?
So I wholehearted agree, but I think I'd like to broaden the discussion a little bit to think about a level playing field and then a fair playing field. And here I'm thinking about levels of risk. And, a loan is a loan and a payment is a payment. But there are levels of risk. When I'm making a payment, do I have to go through the full BSA AML criteria, or are there some ways we could think about tiers within this structure so that if for a small transaction, it's a lot less risky than a bigger transaction? And so I think that, when you start talking about levels, you also, public finance, right? It's horizontal equity versus vertical equity. And, I'm actually for both.
I think.
Well, so I think tying together what Rob was saying with what the congressman was talking about, when you strip away the shiny stuff, it's activities. A loan is a loan. Moving money is moving money, and that is where state regulation and state licensing is grounded in. It's not about a business model. It is about the activity, particularly the consumer-facing activity. And in a lot of these areas, there is a structure that exists, and the challenge is to leverage what exists and to really think about where the innovation sits, so that you're really focused on, as the congressman was saying, whether it's kind of redirecting the assets or thinking about existing regulation and law in a way that captures the reasons why that regulation exists and why that law exists to begin with, and ensures that you are also enabling the constructive innovation.
I want to commend the ABA for the thoughtful approach that they're taking here, because a more likely approach could have been, and maybe was the approach in past years, was to circle the wagons. And some of that could have been driven by remarks of some of these startups and disruptors saying we're out to kill the banks. But the fact that the ABA has acknowledged and evidenced the benefit that can come from these types of partnerships is very reasonable, thoughtful, and I really commend them. And supporting a level playing field, if we're going to partner, it's very natural that we would need a level playing field in terms of regulations and level of oversight.
Great. Well, we heard from Congressman McHenry about his specific proposal, which mirrors the UK sandbox, and since we need to have different terminology now in our era of nationalism, England can have their sandbox, we'll play in our greenhouse. I want to ask you guys, are you for Congressman McHenry's bill?
So I felt like Congressman McHenry was channeling our comment letters because we have a mantra whenever we write to the Bureau or the OCC or the Fed or the FDIC, and we have a number of sort of wish list items. And always on that wish list is a sandbox or a greenhouse. We talk about test and learn and betas in CFSI. But I think that this whole issue of sandboxing or greenhousing, sorry, it does a couple things. Rob talked about the opportunity to test in market and get some real-time data in order to be able to understand what's going on with consumers and the product. There are ways to structure this. You could have like what the UK has is they have a reserve fund. So if there's a financial harm to the consumer can be made whole. That's a real kind of easy way to do that. Providers should be allowed to prove that their products are well built and have strong financial outcomes for consumers, that it improves their financial health. And I would actually ask us to expand our vision for what a greenhouse can do to also say it allows the regulatory community to try out and test. If you're going to put a benchmark level in, then how do you know that number is the right number? If you're going to say $10 billion banks and above, how do you know it's 10 billion? Could we ask the regulators to actually try some beta testing in their processes as well?
All right.
That's it.
So,
Go ahead.
I've been pleased to see the current initiatives of a number of the agencies focusing on innovation. So you saw it at the CFPB with Project Catalyst. You're seeing it at the OCC. I think the Federal Reserve, both at the board level and the reserve banks, has not get enough credit for their early identification of the benefits that arise out of innovation. Governor Brainerd, early on, almost 2 years ago, gave a terrific speech focusing on the benefits, the risks, and the impact it could have on banks, particularly community banks. I think the biggest challenge, though, is this level of coordination. And I've seen real gaps here, even as each of the agencies are pursuing their own initiatives, not including sufficient input from the other agencies.
So do you think the McHenry bill is a good idea?
If it could result in coordination, I think there are a lot of questions that how that would be implemented, and I think depending on how they're addressed at the agency level will depend on will drive its success.
So obviously, given my comments earlier, we were very excited to see the Congressman's proposal. Gene, I think you hit on a few really key points of how this could help benefit innovation. And the first is the regulatory engagement, the chance for regulators to sit in the room with a lot of these innovators and see what these new technologies are doing, to actually get a hands-on experience and figure out how they're working in the real world and become comfortable with them. The more comfortable regulators are with these technologies, the more comfortable they will be with banks and non-banks implementing them and rolling them out to customers in the future. So I think that's a really key component. And I think you also hit on another really important piece, which is how do consumer protections fit into a sandbox? And I think oftentimes the sandboxes or greenhouses get billed as a way to bypass some of those protections. But I think if done correctly, you don't actually lose any protections. You still need the ability to waive certain laws to be able to facilitate some of this innovation. Laws like we were talking about earlier about not taking photos of ID cards. At the end of the day, good regulation is meant to get you from A to Z, where Z is a customer with a financial product that fits them and protects them. There may be some very prescriptive steps along the way. Steps C, D, and E might require me to go into a branch and sign a physical piece of paper. We can waive those rules without giving up any of the customer's protections. So I think that's where the conversation really needs to be, and that gets back to, Aaron, what you were saying earlier of the win-win, not the trade-off between the two.
So I think the bill flags some really important issues that regulators, wherever they sit, state or federal, need to be talking about amongst themselves and across borders, and state to federal. These are a lot of the conversations that state regulators are having right now on exactly some of the suggestions that actually Jean made with her top 3 wish list. It has also, I think, sparked a really important discussion that we hope Congress is going to continue to have too, and look at these issues.
So we're going to turn to the audience in a second, but before that, would be remiss if we didn't really delve into here a little bit the OCC's Fintech Charter proposal, which, in some ways is the elephant in the room, which has really kind of helped crystallize this conversation. And I kind of want to put each of you on the rotating hot seat, if you will, on your reaction to the charter. And Margaret, you drew the straw closest to me, so I'm going to start with you because, in addition, the CSBS wrote a letter. I'm going to say that it took a hard line. Some other folks in chatter have used more colorful language. But it was a pretty strong letter against the OCC's charter proposal. And a cynic would say, you guys are protecting your turf, that this is a federal charter, your states, they're going to be creeping into spaces that on money transmission that have just been the turf of states for a long time. And so I get why the OCC proposal would be bad business for state banking regulators. But tell me why it would be bad for consumers.
At the core of the charter proposal is preemption of a vast range of state consumer protection and licensing laws. Give me a second to tick through a few of those, whether they are state anti-predatory lending laws, state laws governing debt collection, state laws around processing and handling of consumer complaints, just to name a few. And I think that also the fact that this charter will be one designed not to support innovation, but to support the biggest and most well-funded players, ends up being bad for consumers because it tilts the marketplace against the true innovators. And in fact, what it will create is a company by company, for those selected few, it will create a company by company opaque patchwork.
So, Richard, you're one of those big companies. Previously, you were a state banking commissioner for New York. And now, with Lending Club, you're probably one of these large companies that could benefit from a national charter. I get why a national charter might be good for Lending Club. Why would it be good for consumers?
Right. So to be as direct as I can, consumers will benefit from increased market competition, lower prices, increased financial inclusion, better products, and a national baseline of consumer protection driven by the OCC's focus on responsible innovation. There is a potential for much good here, and for the charter to avoid the consumer protection concerns that Margaret just raised, the OCC must be really true to its focus on responsible products and services. So this is, in my opinion, the right way to promote innovation, and in the end, I believe it will enhance the dual banking system, not threaten it. Margaret described the direct lender model with licensing on a state-by-state basis, something I am familiar with from my days as New York superintendent. And while states like New York should be proud of the efforts to promote and ensure consumer protections, unfortunately, this is not always consistent across the country. We also know that regulating a nationwide online business on a state-by-state basis can be challenging. Some states require physical branches, others have multiple different requirements around licensing, background information about officers and directors, and others do not in any way contemplate technology-based companies. We also know that examiner resources are uneven across the country. Not all states have the 1,000 plus examiners and the examination force that New York has. The logic for an optional federal regulator is strong and compelling. And while I would hope that states would respond to the challenge by pursuing multi-state efforts around more uniform laws, home host passporting of licenses, as well as multi-state exams, it will take years to happen if it ever happens. The other regulatory model used by a number of companies, including ourselves, is the issuing bank model, which also promotes and provides the ability to operate nationally along with federal oversight. A federal framework allows new entrants to compete, expand access to capital, and provide lower cost products. In our case, we are filling a gap and also addressing channel conflicts and business model conflicts presented by the traditional banks. Our core product is assisting borrowers in refinancing high-priced credit cards. That is certainly not the incentive for the large retail banks to do. On average, we're saving consumers approximately 7 percentage points, so almost $1,000 of interest. And over the term of our existence have saved $1.6 billion, consumers $1.6 billion. The centerpiece of the OCC charter proposal is a focus on responsible innovation, and that means that a new special purpose charter should be held to new and higher standards of financial inclusion and responsible lending. And to that end, in our comment letter, we propose that the OCC consider a number of strong pro-consumer standards, including a requirement that applicants submit a robust financial inclusion strategic plan, including measurable goals after input from community groups. Second, they should address gaps in protections for small businesses, which are not entitled to the same protections as consumers under small businesses, but are experiencing some of the very same abuses that we saw in the lead up to the financial crisis. We recommended modeling some of these protections after the Small Business Borrower Bill of Rights that we participated in as well. And then the third recommendation around consumer protection was encouraging the OCC to consider a 36% rate cap that could make it clear that special purpose banks would not be designed to support high-priced lenders who may offer products of a predatory or otherwise irresponsible nature. So I look forward to many others. This is my first opportunity to engage with a state representative, and I look forward to further engagement as well.
Well, I think we'll mix this up, and just to explain the math, Richard's 7 points are basically the difference between what you could get there than if you put it on your MasterCard like the congressman's dad did. Because the reality is that the majority of that pre-business lending is coming from home equity, credit cards, or assets. Gene, I mean, you don't have a dog in this fight, and you have the experience of having worked at the Federal Reserve, so you kind of get bank regulatory mindset. What's your take on the OCC charter?
So we actually do have a dog in this fight because a lot of our fintech companies in our lab are really struggling with this whole issue of licensing and chartering. And because of that, our take is the OCC charter is a good tool to have in your tool chest. It's something that should be available to appropriate entities and companies out there, but it's not the solution. This is not a one-size-fits-all marketplace when you talk fintech. So we still want passporting. We still want harmonization. But we would love to have the idea that there is a national charter out there. And Rob actually hit on some things that we feel would be beneficial as a part of the chartering process, in that it would let at least the OCC become a whole lot more familiar with the regulators, get them to understand, have the technology companies familiar with the regulators and the regulators familiar with the technology companies, and be able to move regulation forward in a more fintech-friendly way. Richard also talked about the importance of sort of joint examinations, but even examiner training is really, really important. And so thinking about if you had a fintech charter, you're actually going to have to train your exam staff a little bit differently. And I'm going to say this and make a whole bunch of enemies at the OCC, and bring them into the 21st century. I think that the charter is also an interesting signaling device for third-party entities working in partnership with banks. And so to the extent that this third-party vendor management could almost be a credential that you could use as if I have a charter, I'm probably a safer entity for you to partner with. So I think we really love the financial inclusion focus that the OCC has provided. And we wish that more regulators would sort of think of that, because we agree with you, Rob, that the CRA served its purpose. It can continue to serve its purpose, but it needs a little bit of updating.
So, Rob, Richard flagged this. It would have been very easy for the ABA to come in and say, no way, no how, we're against it. But you guys kind of took this surprising approach that, of supporting it with certain parameters. Can you explain why?
Yeah, absolutely. And, I don't think it should be all that surprising that we supported this. We started off talking about banks are very pro-innovation, pro-partnering. We're excited about a lot of the opportunities that fintech presents. And at the end of the day, we think that these innovations best benefit customers when they're delivered in a safe, responsible manner that is ensured by consistent regulation and oversight. And I think that's what the OCC has done here. To be clear, what the OCC did was not make a fintech charter per se. They made a bank charter that was tailored to the fintech model. They made very clear that all the same rules apply. If you're going to be a bank, here's what being a bank looks like, both in terms of the regulations that apply and what the oversight is and the expectations. So I think going forward, the implementation is going to be really critical here. There are a lot of questions remaining. So the OCC has undertaken a very transparent process so far, and we think this is the beginning of a continued open, transparent process about what this looks like. But there's some really important questions to be answered about what this charter is going to look like before you can actually roll it out. Questions like, will the rules apply evenly? They've certainly put that out there as the goal, but you need to see on paper how that's going to be applied. What are the charter responsibilities? Gene, you sort of hit at their focus on financial inclusion. Again, they've sort of said the right things here, but how they're implemented are going to be very important.
So let's turn to the audience. I see a question right there in the second row. And then
Hi, Ted Knudsen, reporter, Financial Advisor magazine for the panel. What should the SEC do in the next year about fintech?
Well, just like the other agency, I probably should have said, up front how there's a continued focus on the SEC. What I should say is that our current model is operating under an existing regulatory framework, including investor protection by the SEC. So for those of you who may not be as familiar with our model, our funding sources come from both retail and institutional investors. But the notes that we issue that correspond to the loans that are funded by those investors are SEC registered. So you do have an important role for the SEC in the marketplace lending model.
in the back.
So Brian Knight,
Brian.
Mercatus Center. Aaron, thank you for this event, and thank you for plugging our forthcoming work. Good job. This question is mostly aimed at Margaret. So the CSBS opposes the OCC charter, but state-chartered banks enjoy under federal law certain provisions like interest law export that help them compete at a national level. So if a charter's going too far, what's your view of the federal government coming in and granting export provisions through legislation for, let's call them non-bank, if they don't get a charter, lenders, so that they are more comparable to what federal or state and federal banks enjoy?
Well, I think, Brian, your question is kind of talking about sort of comparing apples and oranges. When you look at the OCC charter, it is, as you said and as Rob said, it's about a bank charter. And actually, Rob's closing comments really, or his previous comments, really flagged a lot of the questions that need to be answered with regard to the OCC's proposal and with regard to other, potential federal charters. I think that, we know that there are GAO reports outstanding that Congress has asked for, covering a lot of different areas of fintech, and I think that there's going to be a lot of inquiry at the congressional level. This charter, at this point, the proposal raises more questions than it answers. And I think that your question also kind of suggests a lot of the different interconnections that really a lot of regulators and other policymakers have to think about with regard to financial services and technology.
So the center is here, and I see a couple questions, so I'm going to do a little bit of a potpourri lightning round where I'm going to ask people to give very specific questions. We'll get a couple of them, and then we'll have the panel. I see two right there on the aisle, if you can go right back there.
Thank you. I'm Dave Rabinowitz, and I first used an ATM in Singapore years before they were available in the U.S. I'm wondering how much of that delay was related to regulation and how much was just U.S. bank management decisions.
Okay.
Thank you. Paul Thanos at the Wilson Center. Could any of the panelists comment on, other than the UK, what other countries have regulatory sandboxes in place? And secondly, given that the US and the UK have announced at least their intention sometime down the road to negotiate a bilateral free trade agreement, Could there be a scenario where such an FTA could be a vehicle to create a cross-border regulatory sandbox / greenhouse for U.S. and U.K. fintech companies?
All right, I see one last one in the last row.
Brian Marshall from Americans for Financial Reform. I have a question for those who are proponents of the FinTech Charter. How does it maintain a level playing field if there is no coverage under the Bank Holding Companies Act, and there's a unique resolution process that's neither the FDIC FIREA resolution process nor bankruptcy?
Well, oh wait, there's one more, and then this will be the last one for the potpourri round. The woman in the back.
Hi, as fintech companies are increasingly using APIs to gather information, personal financial information from bank accounts and credit card accounts and student loan accounts, and I've seen some fintech companies even asking you to link to their LinkedIn profiles, et cetera, who among the regulators are looking at potential privacy concerns that come up with this advent that maybe the regulators aren't even asking in their licensing applications about those kind of practices?
Great.
So let me take a crack at that first. I think that raises a really interesting question here. And the conversation about data access really needs to be broadened from just purely access to, when you're sharing your data, what are all the things that go along with it? Financial data is very sensitive stuff. It's not, what did I eat for dinner last night? And you can do real harm if it isn't treated properly. So any conversation about access needs to go hand in hand with security, transparency for customers about how it's used, and really giving them control over that data so that they can make the right decisions.
So when the states, I'm going to also respond to that question first. When the states look at licensing an entity, they look at the quality of the management, they look at policies and procedures with regard to cybersecurity. And so I'm going to take the PII discussion and focus it on cybersecurity. This is one of the areas that is important regardless of your business model as a financial services entity because of that position of trust. And it is an important area where, again, the expectations need to be clear. And there needs to be extensive and focused supervision around protecting cybersecurity.
So I'll take a crack at two of them. First, to the first gentleman, I'm old enough to remember not the era before ATMs, but the era when you had to look on the back of your card for that little thing, and it either worked for some ATMs or not. When I try to explain this to my nephew, he gives me this very blank stare and goes back to his iPad and YouTube. And so what you had was a patchwork of regulations that didn't really cover it, and consumers who weren't sure what would happen with error resolution. And you had banks that were afraid that if the card was stolen, the account was drained, who was liable? And what Congress did in the 70s was brilliant. They put in the Electronic Funds Transfer Act, which used, in my framing, what economists would consider a Coasian solution, named after the Nobel Prize-winning economist from the University of Chicago,
yes.
Ronald Coase, which assigned property rights. And the government's role in a Coasian model is to assign property rights, make them tradable, and get out of the way. And so your property right is on your ATM card, if it's stolen, $500. That's your maximum amount. And in the 70s, that was a lot more money, but you could imagine in today's world a giant food fight between banks and consumer groups about what that dollar limit should be, where they would have fought to the death on Capitol Hill or in the regulatory conflicts. What we found was it didn't matter. Today, most of us in this room have zero liability. And if liability is your chief concern, like the privacy folks, you can get a card and an account with zero liability. Why? Banks were incentivized to invest in the system, they developed it, and then they competed it away because they knew consumers wanted that liability. And that's exactly why extending EFTA into fintech through the prepaid card rule was so critically important.
But the ATM came out of the state banking system and started in Iowa and was a product of the Iowa Bankers Association and working with state-chartered banks.
So with the privacy issue, I think that it's easy to say open data, data access, open APIs, but there is underlying that is a huge, complex network of issues. And CFSI has issued a set of principles for data sharing that I would encourage you to kind of take a look at, because they're not the answer. It's not the who's doing this, but it is here are some guidelines that if you're going to be accessing and sharing data, how do you do that? To the question about where are the other sandboxes, certainly Singapore and Australia are doing sandbox pilot, test and learn, greenhouse, whatever you want to call them. This issue of bilateral agreements is really interesting. Some of you may know the head of the FCA in the UK just recently gave a speech in Germany talking about not just how do we think about regulation within our country, but should we be thinking about global regulation versus individual country regulation? Really a good brain teaser. So I would encourage you to take a look at that speech.
Great. Well,
So I think the other question I wanted to make sure we touched on was the ownership issue with the FinTech charter. I think that's a really good question, and it is one of the pieces that still needs to be figured out, is how the regulatory agencies will work together with this new charter, what the implications are for some of the other regulators. I mean, it's not at all clear today that the Bank Holding Company Act would apply, but I think conceptually, if ownership matters for a full-service bank, it should probably matter the same way for a narrowly chartered bank.
So I think that's right, but I do think it's important. We're working on a piece forthcoming at Brookings that takes what I call the Olympic rings approach to fintech, right? So there are kind of 5 different concepts in fintech: money transmission, lending and underwriting, security and data, advising, and payments. And those are really 5 separate concepts, and they have a lot of overlap, just like the Olympic rings, but they're also a little bit different. If a money transmitter goes under, that's not covered by the Bank Holding Company Act. That's a state-licensed process, and it's built on a concept where if you needed to transmit money, you walked into a store or you, at best, picked up a phone. If I'm driving on a bridge, moving money on my phone, where am I and who's in charge of it? And these kind of money, just thinking narrowly of the lending and underwriting component of the charter, I think misses the broader picture. I'd like to thank our panelists, and if everybody could join me in.